Consumer-directed health plans. Consumer-directed health plans, or CDHPs, also known as consumer-driven health plans, are typically associated with three components: a plan with a relatively high deductible, a personal spending account, and the availability of information tools for enrollees. Promising to control costs and accommodate diverse consumer preferences, CDHPs have a dramatic impact on the healthcare landscape and now comprise a significant portion of the private healthcare market. Judged by market success, these plans apparently have considered appeal. Not all healthcare stakeholders and beneficiaries, however, are enamored with CDHPs, and the allure of these plans comes with some uncertainty and potential unintended consequences. Not surprisingly, CDHPs have been the subject of numerous academic studies, and extensive body of research has been produced. These studies have investigated enrollment trends, plan characteristics, risk selection, characteristics of enrollee, impact on utilization, areas of cost reduction, and many other topics. The purpose of this assignment is to detail the various CDHP plan designs, to explain the legislative measures that have allowed for these plan designs, and to distinguish between the feature of these alternate plan design approaches. Just a side note here, there was no consensus on the definition of a CDHP. However, for this discussion, CDHP will be used as a general term to describe a high deductible health plan combined with the tax advantage savings account. Learning Objective 1. Discuss the origin and development of consumer-directed health plans, or CDHPs. Key terms and concepts. Motivations for CDHPs. Aspects of cost sharing for CDHPs. Concerns about CDHPs. Types of personal health accounts. Content Knowledge Review 1.1. Lists three features that are generally associated with CDHPs. This can be found in your text on page 248. CDHPs generally have a relatively high deductible, a personal spending account, and the availability of information tools for enrollees. The objective of the high deductible is to encourage enrollees to be wise consumers of healthcare services by exposing them to the financial consequences of their choices. Because the high deductible reduces the amount of risk protection insurance provides, a typical CDHP links the high deductible plan with a personal spending account. And the purpose of information tools is to provide enrollees with the resources they need to make informed decisions. 1.2. Explain the motivations for developing CDHPs. This is in your text on page 248. CDHPs emerged as a backlash against managed care plans and the subsequent rise in healthcare expenditures. They were intended to control costs and promote greater value in healthcare spending by shifting responsibility for healthcare decisions making from insurers to consumers. They were also seen as a way to accommodate diverse consumer preferences. 1.3. Describe the types of concerns made by critics of CDHPs. In your text on pages 248 through 249, critics of CDHPs raise three major concerns about CDHPs. First, consumers may not differentiate effectively between more and less valuable care when making choices. Second, there is a potential for greater risk segmentation in health insurance markets if CDHPs disproportionately attract favorable risks due to their lower premiums and higher cost sharing. Third, doubts exist whether or not CDHPs will actually reduce healthcare spending. 1.4. What aspects of cost sharing are relevant to CDHPs? This is in your text on pages 250 through 251. Three aspects of cost sharing are relevant to CDHPs. First, the annual deductible is the amount the enrollee pays out of pocket before expenditures, except for certain preventative services that are exempt from the deductible, are covered by the plan. For example, in a plan with a $2,000 deductible, the enrollee must spend $2,000 on covered services before the plan begins to pay for care. Secondly, after the enrollee reaches the deductible, services are subject to the plan's cost-sharing requirements. Although cost sharing can be very complex, varying both in level and in form across services, a simple example is a 20% coinsurance rate. In this case, the enrollee would pay out of pocket 20% of the fees for services used after reaching the deductible. Finally, most plans have an annual out-of-pocket maximum. This is the maximum amount an enrollee must pay for covered services during a plan year. After the enrollee reaches the out-of-pocket maximum, services are covered in full by the plan for the remainder of the plan year. 1.5. Distinguish between health reimbursement arrangements and health savings accounts with regard to the account funder, annual contribution limits, rollover provisions, and D, non-medical use. This is in your text on page 251 through 252. A. HRAs may be funded only by the employer. HSAs may be funded by the employee and employer, or both. B. HRAs have no federal limit on contributions, whereas HSAs have a maximum allowable annual contribution limit for individuals and families. C. Employers may choose whether to allow funds to accumulate from year to year in HRAs. Employees may also choose whether to withdraw any unused funds in HRAs after employment is terminated. Funds in HSAs, regardless of whether they are employer or employee contributions, accumulate over time and are non-forfeitable. D. Non-medical use is not allowed with HRAs. Withdrawals from HSAs for non-medical use are allowed, but subject to income tax and penalties if the participant is under age 65. 1.6. Evaluate the impact of the Affordable Care Act on the development of CDHPs. This is in your text on page 251 through 252. The enactment of the ACA created substantial uncertainty for CDHPs because of the concern that they would not meet the minimum actuarial value requirements of the Act. The Act also made regulatory changes that reduced the attractiveness of the CDHPs. Despite these concerns, CDHPs have developed a strong presence in the post-ACA health insurance market. Whether these plans continue to gain market share under the Affordable Care Act regulatory framework depends in large part on how price-sensitive people are, as well as how people value high-deductible coverage relative to other types of low-premium plans, such as those offering very narrow networks or tightly managing care. Learning objective number 2. Explain the various choices of ABHPs that can be compared with CDHPs in other health plans. And ABHPs are account-based health plans. Key terms and concepts. Account-based health plan, or ABHPs. Account-based health plans, clarity of tax treatment. Key differences for ABHPs. Rationale for use it or lose it. High deductible health plan, or HDHPs. Content knowledge review 2.1. Describe the initial uncertainty that accompanied early CDHP plan designs and the pivotal regulatory and legislative actions that clarified tax treatment and allowed for the widespread adoption of these types of plans. This is in your text on pages 279 to 280. Initial uncertainty accompanied the early introduction of CDHP plan designs because it was not clear whether the personal spending accounts paired with health plans would possess the same tax advantages that health plans enjoy. Without clarification on the tax advantage statuses of spending account component, CDHPs would be a distinct disadvantage from a tax standpoint. In 2002, the Internal Revenue Service, or IRS, clarified that HRAs, employee-specific accounts established and funded by an employer from which employees could be reimbursed for medical expenses, can be excluded from the taxable income of employees. Subsequently, the passage of the Medicare Prescription Drug Improvement and Modernization Act of 2003, also known as MMA, created another type of account-based health plan, ABHP, the HSA. The HSA remedied the lack of portability, which was a drawback of HRAs. The MMA allowed people to establish or contribute to an HSA when they were covered by a high-deductible health plan, and the legislation explicitly defined the minimum deductible and the maximum out-of-pocket expenditure for a qualifying plan. The legislation also created a preventive care safe harbor, allowing qualified high-deductible health plans to exempt preventative services from the deductible. The ACA mandated that, beginning in 2010, all plans must cover certain preventive care services with no cost sharing. 2.2. Explain the favorable tax treatment enjoyed by HSAs. This is in your text on page 280. HSAs allows for very favorable tax treatment. Both employees and individuals may contribute to an HSA, although neither party is required to make such contributions. Contributions from either party, employer or employee, are treated as taxable income for the purpose of calculating federal income taxes. The law establishes maximum limits on contribution levels. The total combined contributions from both employer and employee must not exceed the governmental limit. Contributions to HSAs may accumulate over time and account holders may account to invest the funds. And account holders may choose to invest the funds. And interest, earnings, or capital gains are also tax exempt. HSA withdrawals are not subject to income tax if they are used for qualified medical expenses for the account owner or a spouse or dependent. Funds that are withdrawn for non-qualified medical expenses are included in taxable income, and withdrawals before age 65 are subject to an additional penalty tax. 2.3. It's a flexible spending account, or FSA, another ABHP, a new variation on the HRA or the HSA. This is in your text on page 281. The FSA actually predated both the HRA and the HSA. The FSA had its origin many years before either of these types of plans, and its use historically had been much different. The Revenue Act of 1978 gave tax favorable treatment to flexible spending accounts for medical expenses. In 1984, the Internal Revenue Service issued a ruling that while flexible spending accounts were allowable, employees must elect a certain amount for the plan year, and that any unused amounts would be forfeited at the end of the plan year. While HRAs and HSAs are almost exclusively utilized in connection with CDHPs, medical FSAs are commonly utilized with more traditional health plans, most notably with flexible benefits programs. 2.4. Can an FSA accumulate funds from one plan year to the next, as do other types of ABHPs? This is in your text on page 281. Unlike some HRAs and all HSAs, unused funds left in an FSA at the end of the plan year were originally completely forfeited by a plan participant. Some slight accommodations were subsequently allowed for carryovers, but beyond a marginal allowance, excess funds at the end of a plan year are subject to forfeiture. These funds are subject to the so-called use it or lose it rule. The rationale for the practice was that the participant was perceived as self-insuring for certain medical expenses not covered in the base medical plan. The argument for forfeiture was embodied in the question, what type of insurance refunds your premium if you fail to experience an insured loss during the period of policy coverage? 2.5. Are there any other types of FSAs beyond those offered to reimburse participants for medical expenses? This is in your text on page 281. Yes. In addition to medical FSAs, there are other types of FSAs permitted under the law. Dependent care flexible spending accounts all allow plan participants to set aside funds on a pre-tax basis to pay for certain expenses in connection with care for dependents while the legal guardian is working. Additionally, there are FSA plans for non-employer-sponsored premium reimbursement, parking and transit expense reimbursement, and adoption assistance. 2.6. Are all HDHPs identical in terms of their operating provisions? This is in your text on page 282. There can be varied features within HDHPs. An HDHP provides insurance coverage for healthcare expenses. The actual delivery model for receiving healthcare services from HDHPs can be varied. Most service delivery would occur through either a preferred provider organization, a PPO, a health maintenance organization, an HMO, or a point of service program, commonly referred to as a POS. Depending on its plan provision, an HDHP may offer the choice of using in-network or out-of-network providers. Of course, utilizing in-network providers would result in lower out-of-pocket costs for the participant and for beneficiaries. With the exception of preventative care, the annual deductible would need to be met before benefits would be paid. The HRA or HSA, coupled with the plan, would allow for the accumulation of savings to assist in funding current and, in the case of an HSA, possibly future period medical expenses. The accumulation of these funds for future time periods permit more expansive flexibility over the spending of healthcare dollars. Learning objective number 3. Describe the fundamental distinguishing characteristics of an HRA and subsequent expansions in HRA applications permitted by law. Key terms and concepts: HRA distinguishing characteristics. Qualified small employer HRAs are sometimes referred to as QSERAs. Individual medical insurance coverage HRAs are IMCRAs. Accepted benefits HRAs are EBRAs. Content knowledge review 3.1. Describe the fundamental characteristics of an HRA. This is in your text on page 283 through 284. In HRAs, all HRAs share certain fundamental characteristics. The HRA is a type of employer-funded health benefit plan whereby employee-specific accounts are created on behalf of employees. Employees can then submit evidence of qualified health expenses to their employer for reimbursement. Employers reimburse employees after employees submit evidence of having incurred approved medical expenses. HRAs only reimburse items such as copays, coinsurance, deductibles, and services agreed to by the employer that are not covered by the employer's standard insurance plan. Unlike an HSA, the HRA sponsor is not required to link such reimbursements to participation in an HDHP. The HRA's plan document must specifically identify at the inception the types of medical expenses that will be reimbursed. A variety of items may be designed for reimbursement or designated for reimbursement. Medical services, dental expenses, plan copays, coinsurance amounts, deductibles, and other items may be designated. Items may vary from plan to plan, and employer may have multiple plans in place, allowing much flexibility in the realm of reimbursable expense. An HRA must be funded solely by the employer. Employees are prohibited from making any sort of voluntary contributions to their HRAs. There is no statutory maximum contribution limit on the amount an employer can credit on behalf of an employee. 3.2. Summarize the legislative and regulatory measures that resulted in expansion of HRA applications. This is in your text on page 284. Various legislative and regulatory measures resulted in an expansion of the use of HRA concept. In 2016, the Small Business Healthcare Relief Act created the Qualified Small Employer HRA, or QSERA. QSERAs allowed small businesses with fewer than 50 employees to reimburse their employees for purchasing health insurance, including such purchases of health insurance through a health insurance marketplace. Later, in 2017, a presidential executive order directed governmental departments to consider proposing regulations to increase the availability of HRAs. On October 29, 2018, the departments issued proposed regulations responding to the executive order. The proposed regulations were then finalized on June 13, 2019. These regulations expanded the means by which a HRA can be used to provide medical insurance coverage by eliminating the prohibition under Notice 2013-54 against the funds in an HRA being utilized to pay or reimburse premiums for individual medical insurance coverage beyond the exception that was previously granted to small employers with the QSERA. The regulations also allowed for the use of HRAs to cover accepted benefits. 3.3. What must employers do to offer their employees an individual medical insurance coverage, HRA, or IMCRA? This is in your text on page 284 through 285. Employers must abide by certain rules in order to offer their employees an IMCRA. The employer must require participants to enroll in individual medical insurance coverage complying with the Public Health Services Act. A balance in an IMCRA would be forfeited if the employee loses their individual coverage. An IMCRA HRA is subject to Consolidated Omnibus Budget Reconciliation Act, or COBRA, continuation if an individual experiences a triggering qualifying event. An employer cannot offer both an IMCRA and a traditional health plan, GHP, to the same class of employees. Prior to the beginning of the plan year, an employer must specify in the IMCRA plan documents the class or classes of employees eligible to participate in the IMCRA. When offering an IMCRA to one or more classes of employees, the same terms of coverage must apply for all employees within the covered class or classes. 3.4. Describe some of the ongoing operational issues related to maintaining an IMCRA. This is in your text on page 285. There are certain ongoing operational issues related to maintaining an IMCRA. For instance, on an annual basis, employees must be given the opportunity to opt out of an IMCRA and to waive future reimbursements from the account. The IMCRA is subject to annual substantiation and verification procedures to ensure the individual coverage requirement regarding each participant and dependent is in place, as well as to substantiate the funds claimed for reimbursement have actually been incurred and paid. Finally, at least 90 days prior to the beginning of the plan year, an employer must provide eligible employees with a written notice. The written notice must contain information regarding the maximum dollar amount of reimbursement, a description of the individual medical insurance coverage requirements, the right to opt out, and explanation of how participation in the IMCRA affects eligibility for the ACA premium tax credit, and the employee's need to provide substantiation of enrollment in individual medical insurance coverage. Also, employers must comply with other relevant applicable laws, including the Internal Revenue Code, IRC, the Health Insurance Portability and Accountability Act of 1996, HIPAA, COBRA, and the Medicare Secondary Payer Rules. 3.5. What is an Accepted Benefits HRA, or EBRA? This is in your text on page 285. An EBRA allows employers to provide a tax advantage benefit beyond the employer's general health plan to employees who choose to be covered by short-term medical insurance or who are seeking to be reimbursed for the cost of copays, deductibles, or other expenses not covered by the general health plan, or other accepted benefits such as short-term medical insurance, limited scope dental or vision expenses, and benefits for long-term care, nursing home care, home health care, or community-based care. 3.6. What requirements must an employer fulfill to offer an EBRA? This is in your text on page 285 through 286. An employer must fulfill certain requirements to offer an EBRA. For instance, the employer must provide some other general health plan that satisfies the PHSA requirement to the same participants who meet eligibility requirements for the EBRA for the same plan. The eligible employees must have the choice not to elect coverage in the general health plan and solely enroll in the EBRA if they choose to. The amount made available through the EBRA cannot exceed a legally set level that is indexed annually. The amounts in an EBRA cannot reimburse premiums for individual medical insurance covered under a GHP other than COBRA or Medicare Part B and D. An EBRA must be made available to all similarly situated individuals under the same terms regardless of any adverse health factors. An EBRA cannot be offered only to individuals who have a serious medical condition or ultimately offered only to those who can pass a physical examination. An employer with more than 100 EBRA participants must file a Form 5500 if it is not including the EBRA as part of the employer's medical plan. Form 5500 filing Other disclosure requirements like distribution of a summary plan description, SPD, are necessary. Unlike the rules for IMCRAs, there is no specific exception from the Section 105H non-discrimination rules for an EBRA. Accordingly, an EBRA providing a richer benefit to more senior employees can be found to be discriminatory.
Next.
4.5. What factors are likely to impact the prevalence of employer-supported for CDHPs and the selection of CDH plans by employees when given the choice between CDHPs and other medical plan offerings? This is in your text on page 290. Several factors are likely to impact the prevalence of employer support for CDHPs and the likelihood that employees will choose CDHPs when given a choice of plan selection. Depending upon the escalation in medical cost inflation, general economic prosperity, labor market conditions, and employer willingness and ability to cost share with employees is underwriting medical expenses. The appeal of CDHPs will likely vary over time. The popularity of the CDHP choice from the perspective of both the plan sponsor and the individual participant will also vary between industries with different economic and competitive pressures. CDHPs are definitely an enduring type of plan that will continue to see future innovation and adaptation to evolving technology and market conditions.